welcome back. You're watching Stockwatch with me, Julieta Televi, and join me to take your stock-related questions this evening are Deryck Janse Van Rensburg from Anchor and Ricus Reeders from PSG Hole-in-One Ruimsig. If you'd like to send questions, please do send to stockwatch@bdtv.co.za or via SMS on 41392. Deryck, Ricus, good evening to you both. Deryck, if I may start with you, it was a bit of a mixed bag on the JSE today. The overall close seemed to be a little bit negative. But there were some very good gains on a couple of big shares, notably Bidvest and Aspen. As far as Bidvest is concerned, they came out with results. Do you think they broke kind of the hoodoo that the stock had been trading under? Everyone got very nervous about them, in about October last year, and they just basically reassured the market?
No, absolutely. I think if you just look at what's on offer from a JSE perspective, one has to, obviously stick to good quality businesses with diverse revenue streams. And I think Bidvest as a sort of diverse industrial business certainly ticks a lot of boxes. So, lots of avenues as to where revenues are coming in, but certainly managing a very tough economic environment from a South African perspective and really delivering on the goods. So if you just look at some other SA Inc. equity that's been reporting of late, we've seen some softer results. You look at things like Supergroup that released, the backdrop within the context of the economic environment. It's tough out there. We're in a high interest rate environment.
Yeah.
And I think Bidvest really did bring the goods when it comes to, delivering a good set of numbers. So, and also their prospect statement looking quite strong.
Yeah.
So I think cautious, but optimistically cautious. So I think a great set of numbers.
Ricus, one of the questions that we got in the last 2 weeks about Bidvest was whether there was a fundamental problem, and I think it was either David or Wayne on the show last week saying there wasn't a problem with the company, there was maybe a problem with the share price. Does that, that it got ahead of itself when it came out with an update that the market got a bit spooked by, the shares came off very, dramatically. Would you say that encapsulates that actually it's a solid company, it's worth buying into, and especially at lower levels, and it was just that the stock got ahead of itself?
Yeah, I think so. I mean, it's sitting on excluding these results, sitting on a price earnings of 13, which is not excessive for what is essentially quite a defensive company as far as the operations are concerned. A lot of their revenue growth was through acquisition, but that's not new either. It's what Bidvest does, and they've been executing that kind of growth by acquisition pretty well historically, so that's not a bother. They've maintained margins, and I think the, shall we say, disappointing trading update they had was as a result of what's happening on the macro level locally. But again, these results just show that considering their size, considering their operations, considering their operational management, it is a core holding if you want to have anything to do with SA Inc.
Yeah. And I suppose maybe, that's the big question, whether or not you want to have anything to do with SA Inc. Deryck, how are you feeling about the prospects for local shares? Because it's really been, it's quite grim out there, and its volumes have been grim. What was it? Italtal described the environment as unrelentingly tough. Do you see any bright spots on the horizon?
Yeah, look, if you just look at our local market and compare it to the rest of emerging markets out there, certainly we are definitely on the cheaper end of that spectrum. Okay, that said, we can argue we're cheap for a reason. So obviously the prospect of future economic growth is pretty benign where we sit at the moment. We're obviously in an election year at the moment, so we need to see what the political landscape starts to look like over the next couple of months. So, all that said, I think, the impact of load shedding, the impact of, lack of electricity has certainly impacted the operational management of a lot of SA Inc. at the moment. I'm not overly bullish about it, but what I can tell you is that there's a range of companies that are very cheap at the moment. If the sentiment towards South Africa starts to change somewhat, which I can't see in the short term, then there could be a definite uplift in terms of some of the share prices that we see at the moment. But for now, where we are and how we stand at the moment, I'm a little bit reluctant to kind of beat the drum with some high conviction calls when it comes to SA Inc. And I'll probably be a bit cautious and say, you got to follow the economies that have got the backdrop of economic growth. And that just really talks to the developed world at the moment, and in particular the US, which is where we're seeing a lot of the global growth come from at the moment. So that's kind of where I sit at the moment.
Ricus, are you in the same camp? I mean, just about everyone is, to be fair.
Yeah, I think so. Historically, our markets, or the performance of companies in South Africa, have been driven by the resource cycle. Resources do well, and money flows into South Africa, whether it's, based on what's happening in mining activity, and industrial companies benefit from it. But the problem at the moment is that even if we do have a resource boom or a nice boom market in resources, your local companies can't really take benefit from it because of the constrictions as far as electricity, transport, export legislation is concerned. So this time, and I hesitate to say it might be different. So your mining companies might possibly do well, but there's such a lot of constraint as far as infrastructure is concerned that the full benefit of a global commodity bullish trend will not directly benefit local companies. And I think that's why, when measured against emerging markets, I think we are the worst performer yet to date. It's not really sentiment, it's real constriction in the operating environment.
Yeah. Okay, well, on that basis, a viewer sent in a question about a clutch of companies on a 5 to 10 year outlook. Mr. Price, Clicks, Mondi, BHP, and they've said ABI. So I'm just trying to, I wonder if that's AB InBev or AVI that they're asking about. But I'll start with Mr. Price and Clicks. Deryck, is there anything that attracts you to South Africa's retailers on a longer term view?
Yeah, I think, as I said, if you just look at it relative to some of the other emerging market retailers out there, we look very cheap at the moment. If you are going to build a portfolio, I would certainly say your top retail picks are Mr. Price. I really like Clicks. Management have proved themselves year on year, even through a very tough economic environment. And the other one that you could probably add to the list there is Shoprite. I think that they've certainly put themselves on the front foot, started to really capture some decent market share out there. You compare it to the likes of a Pick n Pay, which is in a very difficult, precarious position at the moment, but certainly probably some light at the end of the tunnel, but a few hurdles to cross where we sit at the moment. So I like those two stocks. I like Clicks. I like Mr. Price. Dis-Chem has also come back into the force somewhat with some decent store rollout. But yeah, I think, as I said, you could probably throw a Shoprite into the mix. There's some decent retailers. There's some leveraged earnings effect if we just look forward. If we do start to see lower interest rates and a lower interest rate environment and consumer spend starts to pick up, then I think Mr. Price, Shoprite, Clicks are well placed to capture that extra spend. But we've got to be patient for that. But certainly with a 5-year view, they look good. They're good quality businesses.
Yeah. Ricus, what's your view on, well, specifically those two, but any of the other retailers? I mean, I noticed, Deryck, you don't mention any really of the credit retailers, the apparel retailers, as it were, other than Mr. Price. But Ricus, first, your thoughts on Mr. Price and Clicks.
I totally agree with Deryck. It's what I would have chosen as well. And that's based on current fundamentals and possible capital appreciation. But I got asked the same question last week as to a 5-year outlook. And as I said then, and I still maintain it, I don't even know what's going to happen next week. So from an investor's point of view, it's not necessarily the company that you invest in. It is your investment self. And by that I mean, is you've put 100 Rand into the market and you want to achieve a certain return over the medium to long term. And then it doesn't really matter what the company does. It matters as to what kind of return you get in terms of the price movement and also the dividend that you receive from the company. So fundamentally, Mr. Price Clicks, all of those might be, shall we say, the best company in that sector to invest in. But if the price and dividend return on your investment doesn't satisfy that goal that you've set yourself, then it doesn't really matter, because then you just invested in a good company, but you're not really making money. So as with all things, over a 5-year period, one should track as to whether one's investment is actually generating the return that you want, rather than concentrating on whether ShopRite is a great company or Pick n Pay is a terrible company.
Yeah. What about Mondi and BHP? A viewer also last week said that they'd been really disappointed by the investment in Mondi and actually didn't know whether now was the time to sell, because they suspected that if they sell now, this is going to be the bottom for Mondi, and it's only going to get better from these levels. Deryck, firstly on Mondi, would you be prepared to give it like an ANC voter another 5 years?
Look, I think Mondi are in a little bit of a short-term precarious position. Previously was a very well-run business, but I just think that the space that it's operating in at the moment, given the fact that we, in this high interest rate environment, I'm not too bullish on it. I just don't think that I'd like to see a little bit of consolidation in terms of operational consolidation, get costs under control, start to move the business in the right direction from a HEPS perspective. I don't think we're there yet. I think it's about a 12 to 18 month type turnaround story that's going to take a little bit longer than what we expect. So I'm not extremely bullish on it. And I think if you are going to look at JSE listed companies, there's probably some better quality out there than where we sit at the moment with Mondi. Nevertheless, if you just go back over the last 5 years, it is a well-run business, but I just think if you are going to look at bottom picking or fundamentally bottom picking JSE listed businesses, there's better picks out there at the moment as opposed to Mondi.
Ricus, no one seems to be particularly enthusiastic about it. Also they come up against other producers in the world, craft paper producers, packaging companies. Is there just an industry that is too big that they can't dominate? They can't dominate they have no pricing power. Is that maybe the fundamental problem that Mondi experiences?
I think, from my perspective, there's two things. I've always liked the innovation as far as their products are concerned. They certainly, it's not same old, which has always been a positive for me. But what's happened over the past 3 years is that they've lost a cost advantage, in that they basically lost their cheap source of wood in Russia. So that's affected how much they pay for the wood that they're going to turn into pulp. That's held the price back since the invasion of Ukraine by Russia. Although they've got rid of those operations, it still means they've got to source from somewhere. Secondly, as we all know, packaging is cyclical, and they're not, and we're sitting in Europe, and that's not doing too well. Caveat there is that I think Europe is at a point where they could start outperforming, or at least start doing a heck of a lot better than they've done over the past 2-3 years, the economy-wise. And the European markets are already telling you that, with the DAX and the CAC 40 breaking to new highs. So Mondi might rise on the tide, but it's still, if that is the case, it's still not the best vehicle to take advantage of any turnaround in the European economies, and with that, the turnaround in European specific companies.
Yeah. I must say, I always thought Mondi was going to be a play on the increasing move to, the Amazonification of our lives, where you order online and you get your stuff delivered to you. But that hasn't necessarily played out for them. What about BHP? Deryck, would you avoid BHP for the foreseeable future until there's some sort of evidence of an uptick in the commodity cycle? Or is now, in fact, the time that you would buy BHP if your outlook is 5 to 10 years?
So, BHP, you've got to look at it as very much a global player, not necessarily just a South African, mining asset that you're looking at buying. So to answer your question, I think commodities have been extremely soft. Even through the course of 2023, where we saw rampant US markets, we saw a very soft performing resource and commodity market. And, that all stems from a high interest rate environment and obviously elevated CPI data that just really puts the handbrake up on growth. We also didn't have the backdrop of a strong stimulating Chinese economy, which a lot of people have been calling for some time and is just not necessarily playing out as quickly as what investors probably would have liked. Do you buy it now? I think you've got to start nibbling. I do think that, these are very cyclical businesses. Commodities in general are always going to be cyclical of nature. And I think we're quite close to bottom of the cycle stuff on it. It could come a little bit lower. But there's, any uptick in commodity prices from these levels, and you're going to get some decent earnings coming out. And also through this very tough period that they've been through, they've spent quite some time obviously focusing on the cost side of their balance sheet and making sure that it's running as lean as possible and obviously retaining as much cash as possible. The long short story is, even in a very tough commodity environment, they're decently cash generative, and if we do see an uptick in commodity prices from these levels on the backdrop of global growth, then I think they're going to deliver some decent returns. So yes, I think you can buy it. Stick to the diversified resource players.
Very quickly, Ricus, your thoughts on BHP, just from a shorter term trading perspective. Is there anything encouraging for you that would convince you to get in? Or do you think there's still sort of lower levels to be hit?
It sounds like I'm just parroting Deryck, but I agree exactly. In my own model, I'm at a 2/3 of a full weighting.
Okay.
In BHP, and for exactly the same reasons that Deryck has. I think it's globally diverse. I wish they would. They've had a couple of bad news stories over the past number of months, and there's some liabilities, but that's the cost of running a big mining operation. It's a dangerous thing.
Yeah.
But whether it be 3 or 5 years, I wouldn't necessarily want to hold it for 5 years. I will hold it until we get an upswing in the commodity cycle, and that commodity cycle starts turning, and everybody wants to buy BHP. But then that might be next year, 4 years from now, 5 years, or 7 years from now. But we're not in an expensive area of the BHP share price.
Okay. If we have a look at some of the results that came out today, or trading updates, Maraf came out with one. I know it's a small company, but it does appeal to the small cap punters amongst our viewers and myself, certainly, although I don't hold shares. They said 4 to 24% increase in HEPS that they're expecting, which is a pretty large range, and their share price was up, 5 or 6%? But I noticed that they said of the cash that they have on hand, they said 328 million of, I think I understood this, the 697 million that they have on hand is for environmental rehabilitation. And I wonder if that didn't mean to potential punters that there's not going to be as fat a cash dividend that maybe we had hoped for. Or am I reading too much into this? Deryck, what did you think?
I think this has always had a very sort of strict dividend payout policy, and you've obviously got Big Brother Glencore in the picture there that are expecting cash flow out of it and from their investment. So I think what spooked the market initially is you saw a decrease in chrome production. So you've got to differentiate between the actual chrome ore that they're obviously selling to the market and the actual chrome concentrate. And I think that just if you look at what chrome prices have done, it made sense to dial back on the chrome ore component and then rather focus on the chrome concentrate component of their business, which is why they've actually, although done lower volumes that were depicted to the market previously, they've actually delivered a decent set of numbers. That said, I think a lot of the money that they got on hand, and obviously sustainable energy solutions looking forward, may be allocated to new energy projects or something to obviously streamline the operational performance of their mine, so that they can obviously not rely on the load shedding component and the switching off of that. So all that said, I think the business is in a very healthy space. It's on a very low multiple. You're going to get some nice yield out of it, and that's really what really pushed the share price towards that 140 level. Well positioned. Again, a little bit of a commodity. Well, it is a commodity play. So you got to watch that chrome price closely, and then obviously keep an eye on production updates out of the business. But I think it's in a strong position. Its balance sheet is healthy, good cash flow to be seen from a yield perspective.
And Ricus, if I can ask you on Aspen, and then I'll get to your stock picks. Aspen came out with results which was sort of hard to read in a way. They had a sort of a 10% increase in revenue, but HEPS were down, cash flow was up. What did you make of the numbers?
I had a glance through it, and it's not something that I follow very closely, but the idea I got, and Deryck probably knows more about this than I do, but the idea I've got is that there's huge operational gearing locked up into it that hasn't yet come through. So operationally, they've got a lot of capacity that, if and when used effectively, can have a huge effect on the bottom line, but not yet. The market likes the share price, or likes the update. So there is some future confidence in the ability of Aspen to execute. From my side, I would like to see numbers on the ground before I just buy the hope. I'm not sure whether Deryck will agree. As I said, he probably follows it
Deryck,
a bit closer than I do.
Quick comment on Aspen. I mean, the shares were up almost 6% at one point, then they closed about 3% higher, so there was a little bit of a pullback.
So remember, Aspen always sat on high levels of debt, okay? And that really is what pushed it into a very poor performing stock as we went through the last 3 years. Obviously started to pick up. I think the big sort of takeaway from the numbers that I saw today all pivoted around the cash flow generation. And that just talks to the organic earnings underpinned by the businesses that they own. So I think if you just analyze the numbers, and I haven't gone through it in detail, obviously the HEPS number doesn't look great on the face value, but if you look at the cash flow generation, what they told the market 2 years ago, where they were going to probably step back on M&A activity and acquisitions and try add to earnings by acquiring other assets, they focused on the organic streamlining of the current portfolio on hand, and I think that's coming through now. So I think what they promised the market saw today, and it's all pivots around that operational cash flow earnings number, which was very strong and improved. So I think we can look forward to some better cash flow generation as we move through the next 6 to 12 months out of Aspen.
Okay, James, last 2 minutes. Your stock picks, Ricus, what are you going for tonight?
It's international. It's Pearson International Publishing Company.
Oh yes, Pearson.
Scholarly books, Financial Times. Interesting is and this was a stock pick a while ago from me, is the way they're using large language models applicable to their own in-house research, which is not accessible to an outside company. So unlike ChatGPT, where you might ask something and get nonsense, with Pearson, if you are prescribed to Pearson, whether it be a scholar or an outside, their large language model uses their research to give you an answer, so you don't get gunk. It's a huge competitive advantage as far as I'm concerned, and they are the biggest player in publishing. Great results, and you actually saw that part of their business coming through. It's going to change their income model.
Yeah, and share price performance really strong. Deryck, how about you?
Okay, so I'm going for a global player, Yum Brands, tonight. I think if you just look at the way that the business is positioned, it operates in a segment where people, in a tough economic environment, people don't necessarily hold back on quick and easy fast food solutions, which is obviously where this business is well positioned. It's got geographical exposure across the globe. And hopefully we do start to see this turnaround in China, where they've actually got some decent exposure, and we start to see an uptick in some spend in that space. So in terms of the portfolio of assets, the space it operates in, where we are in the interest rate cycle, I think it does look interesting. It's not fundamentally demanding, and I think it's a nice place to hide in a market that's been driven so much by your Magnificent Seven and your big tech players. And I think this looks quite interesting from a fundamental perspective at this point, and hopefully some leveraged earnings as we see better interest rate environments.
Okay. Well, two entirely non-Magnificent Seven picks this evening, so thank you for those. Deryck Janse Van Rensburg is from Anchor Capital. Ricus Reeders is from PSG Holding One Ruimsig, and we will be back with Stockwatch tomorrow night. Up next, though, the close. Stay with us.